Good morning, everyone. My name is Brian Barksdale, and I'm a partner with Carr, Riggs & Ingram, and I'm going to be serving as your moderator today for our webinar on the new nonprofit reporting standard. I know that we've got a healthy list of attendees today. We have others that will still be joining us along the way, but we did want to go ahead and get started so that we can move ahead with our presentation. As we do get started, I would just like to make a few brief administrative comments and notes. Everyone will remain muted during today's webinar, but if you have questions as we move along, please be sure to type those into the GoToWebinar control panel that should be on your screen. We'll use some time, whatever we have available at the end of our session, to go over those questions and to try to provide answers for you to give you some assistance on applying this new standard and anything else that you may have. You may ask whether we're providing CPE credits for this webinar. The answer to that question is no. We've not tried to go through the process of registering the content with each state's Board of Accountancy, and we do have people joining us from quite a few states this morning. So this content is really just being provided for your information only, not for CPE. Often our webinar attendees will ask along the way about the ability of a recording of the webinar after it's finished, in case you wanted to go back and check something that you didn't catch the first time, or in case someone else might want to take a look at it. The answer is yes. We did have some people who were not able to attend today when they registered, but said they wanted a copy of the recording once it was done. We'll be sending it out to them. But we'll also be sending a link of the recording to all registered attendees within the next 24 hours. We do not distribute the actual slides, but you'll have a recording of the webinar itself. Just as we get started, I'm going to be introducing ourselves, the leaders of the session today. Again, my name is Brian Barksdale, a CPA with Carr, Riggs & Ingram, and been here really almost 40 years ago when I came. So I tell people all the time that I feel like I went from paper route and lifeguard to straight where I am today. I'm a really unusual person in that I've really never been anywhere else. And so this is my home, this is my life. I am known as boss to my 4 grandchildren. And I do have a little unusual hobby for most accountants, I guess, and that is road racing motorcycles. So the high-speed road course kind of thing where you're somewhere between 150, 185 miles an hour. So that's a little unusual, I think, for most CPAs. Next, I'd like to bring up David Alvarez and let David introduce himself.
Hello, my name is David Alvarez, and at 14 years experience, I actually just have a tad less than Brian. I'm an audit partner in our Tampa Bay offices, and I specialize in audits of nonprofit entities. And actually tomorrow, I'll be taking my 2 young boys to Disney. Not quite the nonprofit activity, but should be a lot of fun. On to Alyssa.
Good morning. I'm Alyssa Hill. I'm a partner in our Houston office. I'm mom to a 13-year-old boy, and I love to travel, Aggie football, and I love to run. And actually, I have completed 9 marathons to date, and next month start training for number 10. So while David is off running around with his kids in Disney, I will be starting to pound the Houston pavement in our heat and humidity. So that's just a little bit about me.
Great, thank you, Alyssa. I have to admit the thought of running 9 marathons kind of just scares me to death, but I'm glad that there's somebody out there who wants to do that. As we begin today, let's take a look at the key objectives that you see on your screen there. These are the key objectives that were recommended by the Financial Accounting Standards Board, or FASB, their nonprofit advisory committee. The NAC was formed originally to address the issues about financial statement presentation. The questions they were asking were things like, is anything missing? Is the information that's in the financial statements in the right format? What is it that could be improved? And the committee, among other things, found that you really can't just look at the cash balance and unrestricted net asset balance of an organization to determine the health of that nonprofit. The statement of activity is all a lot of numbers, but they decided it really doesn't say enough about the operations of the nonprofit. The other point that they made was that financial statements between organizations are not necessarily comparable, especially for different types of nonprofits. That is, you could have a healthcare-based organization statements that might look somewhat different from a trade association or maybe from a political lobbying type entity. So the goal of this FASB standard is to bring consistency to all nonprofits, regardless of entity type or structure. The committee also recognized that the success of a nonprofit organization really can't always be told in just 1 year, as we know, with maybe a large temporarily restricted net asset balance and then a small unrestricted net assets. This new concept that they're introducing will help tell the long-term story for a nonprofit organization. Just like the Dr. Seuss books like One Fish, Two Fish, Red Fish, Blue Fish, there's a story, and a story that you need to tell for your nonprofit organization. The story for nonprofit financial reporting has really kind of gotten a bit old and stale. Those of us who have been around for a long time recognize that it's kind of hard to believe, but for many of us, but it's been 20 years ago, more than 20 years ago, since the last major revision to nonprofit reporting standards, which took place with FASB number 116 and 117. I think we would probably all agree that the world and business has really changed dramatically in that period of time. Also, it's become pretty clear that we need more information about financial benchmarks and analysis of such things as how liquid is the nonprofit? Can it really thrive in an unexpected economic downturn, which we've seen before, or an entity crisis? These days, it seems like even just one negative story in social media can have drastic implications on the operations of both commercial businesses and nonprofits alike. So as we look at it, what changes and the needs are the new standards? What's it intended to address? Well, first is the complexity in the current terminology and the use of net asset classes. For example, the terms temporarily restricted and permanently restricted have really caused an awful lot of confusion among our nonprofit organizations over the years. I really probably can't count the number of times that I've personally needed to explain the concepts of those terms to nonprofit management, personnel, and boards. We'll now be using the terms net assets without donor restrictions and net assets with donor restrictions. As a disclaimer, we'll try to avoid using that old terminology for net assets during our presentation today, but we've got to admit that old habits die hard. So bear with us if we mistakenly use the former terms. Secondly, it's really become clear that nonprofit donors, lenders, and other interested parties need more information about the nonprofit organization's liquidity. That is, how much of a nonprofit's assets is available to meet the organization's short-term needs. To answer that question and others that are related to the short-term health of the nonprofit, a lot more data about both quantitative and qualitative aspects of the entity's financial situation need to be available to the financial statement user. In addition, most of us who work in nonprofit accounting and reporting sector would likely agree that there are a lot of inconsistencies in the reporting of expenses among categories and particularly among classifications. These issues revolve generally around understanding the concepts of both natural and functional categories and methodologies for how expenses can be allocated between those. Lastly, the issue of cash flow reporting in nonprofit organizations has really been debated for quite some time. I know I've heard it for many years, the question about exactly how cash flows should be reported. The cash flow statement is a little understood and I think pretty underemphasized financial statement that many statement users find to be somewhat troubling. So the new standard addresses those concerns and attempts to deal with cash flows from operating activities in a way that will be better understood and followed. So we've got this new standard. It's now been approved. It's been officially issued. Like many others, it provides for an implementation period that will hopefully enable nonprofit organizations to have sufficient time to make the necessary changes in their reporting systems. All of the statements provisions that we'll be talking about today they're all effective for fiscal years beginning after December 15 of 2017, which for a calendar year organization means 2018 years and any fiscal years that end in 2019. So we do still have time for implementation, but we need to be moving ahead with it. Maybe many of us are just procrastinators, and whenever a standard isn't immediately applicable, we tend to set it aside and ignore it until the last possible minute. I know this has been true throughout my career. I've seen standards with 3 or 4 year implementation periods, but I could easily tell that clients waited until the year that the standard applied before taking action. So our purpose today in our webinar is to give a brief overview of the standard, the implications that you may need to begin to consider before the last possible date. One other implementation note before we move on. FASB decided that the nonprofit should apply these changes on a retrospective basis for all years presented. However, if you're presenting comparative years, which we normally do, most of our clients do, we do have the option to omit the statement of functional expenses if not previously required to present it, such as voluntary health and welfare organizations, and the disclosures around liquidity and availability of resources for those earlier years. That brings us to our first poll question of the day, to get some information from each of you about this particular question. How familiar would you say that your top management personnel are about the new standard currently? Very much, somewhat, very little, or not at all. Everyone, please take just a few seconds and go ahead and record your response so we can kind of get a feel for what those numbers look like. While we're doing that, I want to just note that we'll mention this a little more later, but this new standard is really the results of part 1 of the FASB committee study, consideration of nonprofit accounting and reporting. Some issues arose during the board's discussions that were deferred over to phase 2. That includes some continuing discussions about measure of operations and cash flows. There's really no expected timeline for phase 2 yet in terms of when that should be completed, but it will be coming up, and so we'll be looking forward to that in the next few years. If we could, we'll go ahead and close the poll out. Most people have voted. Let's take a look at what we have here. Probably about what I would have expected, I guess. We said 4%, only 4% said very much, 27% said somewhat, 39% very little, and 29% not at all. So we have the majority is certainly very little or not at all. So that's something, again, hopefully we're giving some education about that today, and hopefully you, if you're the CFO, will have the opportunity to share with your other board members, CEO, and that type of thing, so that everyone will begin to become familiar with it, and you can go ahead and begin to adjust your financial reporting to the new standard. All right, next we'll move to Alyssa to talk about our first topic of the day.
Okay, great. Thanks, Brian. All right, so we are going to start with net asset classification. And as Brian mentioned a few minutes ago, the current presentation includes the three net asset classes: unrestricted, temporarily restricted, and permanently restricted. And under the new standard, you'll have only the 2 classes, the without donor restriction and with donor restriction. And, you know, as Brian mentioned, the old terminology was often confusing. There were a lot of inconsistencies among reporting by nonprofits, and it really didn't tell users of the financial statements everything that might be important. There actually was another key driver, and that was ABMIFA. And when ABMIFA was enacted a few years ago, it casted doubt on the definition of permanently restricted. As ABMIFA, really what it did was it changed the old law, which precluded spending below the original value of the contribution. And the theory is that managers, you act prudently in establishing your spending policies, and a temporary dip in a gift value should not preclude appropriation of funds. So ABMIFA looked at that and said, yeah, let's make some changes. So the result of this change in law and all the other items FASB was facing made it an ideal time to make these changes, which is how we get the with donor restriction class. This class includes your donor and grantor imposed restrictions, your time restrictions, and it also includes both temporary and perpetual restrictions. Your without donor restriction includes everything else that doesn't have a restriction, and that's also going to include any board designated net assets, which we'll talk about in a few minutes. So here are 2 examples of the balance sheet or the statement of financial position under the new standard. The first example, the top one, represents, this is the minimum presentation requirement, 2 lines, without donor restriction and with donor restriction. An alternative presentation, which is the second one, disaggregates these 2 line items. Items you may choose to include, such as showing your undesignated and board-designated amounts. Those would go under your without donor restriction class, and your time, purpose, and perpetual in nature totals under the with donor restriction class. Perpetual in nature, you'll see and hear that term, and that's your old permanently restricted, and perpetual in nature is what's replacing that term. Now, these are just 2 examples. The level of detail you choose to show, it should be meaningful to the users of your financial statements. The new standard provides examples and minimum presentation requirements, but ultimately the amount of detail is really up to you. So regardless of which presentation you use on the face of your balance sheet, the notes to the financial statements will likely contain much more detail. Now, just as we saw on the collapse of the net assets section on the balance sheet, we see the same collapse on the statement of activities. You now have a without donor restriction and a with donor restriction column. Other than that, there really are not that many changes to this statement. As an organization, you may still choose how much detail you want to include under your net asset released from restriction section. You can choose to show more detail on the face of your statement, which is shown in this example here, but just know that if you're not disclosing it on the face, you're likely going to be disclosing more information in the notes. What will be a new required disclosure relates to board-designated net assets. Under the new standard, you must disclose the nature and amounts of board-designated net assets. Currently, there is much variation as to what organizations disclose. Some disclose a great amount of detail in this area, some may be a total only, and some organizations really don't disclose anything at all. That variation goes away under this new standard, and that you must disclose this. The other component related to this area is that in the past, this has likely been an informal policy as to how designations are established or released. Maybe a designation was established 20 years ago and no one remembers why, what the basis for it was, or how the amount maybe was even determined. This is not uncommon, so this is why the standard indicates that the nonprofit needs to have formal policies and procedures in place related to this. Things you might want to consider in this policy, such as, what is required to establish board-designated net assets, maybe conditions under which net assets are to be designated and in what amounts. How can the assets be spent, or how can the assets be released from the designation? Can any of this be delegated to management, or does it reside at the board level for all those items? Items you may need to consider depending on how much or how many designations your organization has. Just know, end of the day, there's likely a more formal process than some of you have in place today, so just want to make sure everybody's aware of that. Okay, as I mentioned previously, the face of the balance sheet, and as we saw on our previous slide, likely shows less detail now. And if that is the case, then a note disclosure which details the restrictions will be required. The same holds true for the statement of activities and detail of the releases of restriction. If it's one line item on the statement of activities, then a note with additional detail may be necessary. So what this example is showing us are the different components that may be restricted either temporarily or are perpetual. The first section, subject to expenditures for specified purpose. These are going to be your funds that have donor or grantor imposed restrictions. They may be program related or capital. Likely the organization, you just haven't incurred the costs yet to release those funds. The second section, subject to passage of time. These are your timing restrictions, such as maybe a multiple year grant payable annually. The third and the fourth sections address your endowment. The third section is subject to appropriation and expenditure when a specified event occurs. This section, this represents your accumulated unspent endowment earnings. You may have several programs or purposes for which there are restrictions, and you would detail those here. That would be detailed within this section. Whereas the last section, subject to nonprofit endowment spending policy and appropriation. This section represents the historical gift value and any earnings that are required by the donor or maybe by law to be maintained in perpetuity. Notice, this doesn't say cannot spend. We don't see the word permanent anymore because remember, under MIFA, you can potentially spend those funds. And when that occurs, you've created what's called an underwater endowment. So let's talk a little bit more about underwater endowments. All right, real quick, before we discuss this underwater endowments a little bit more, I want to just remind everyone that this standard is primarily a presentation standard. Everything that we've talked about up to this point, and with the exception of the next couple of slides, everything else we talk about is primarily presentation. The standard actually only includes 2 accounting changes, both of which impact the net asset classes, so that's what we're going to talk about in this section. And the first one that's an accounting change relates to these underwater endowments. So if the fair value of an endowment fund is less than either the original gift amount or the amount required to be maintained by the donor or by law, whether that be from a temporary investment losses or spending, you will now present the entire balance of the endowment fund in the with donor restricted class. Previously, you segregated that underwater piece in the unrestricted or the without donor restriction. That all stays now within the with donor restricted class. And of course, that means more disclosures. So under the standard, you will be required to disclose the amount underwater, which includes disclosing the original gift amount, and that's so that the users of your financial statements have a perspective on how underwater the endowment is. In addition, you will need to disclose your organization's interpretation of the ability to spend from underwater endowment funds. Okay, so let's look at an example on the next slide, please. Okay, so here's an example, and really these 2 tables are not new disclosures for endowments, but there are noticeable changes within them. The first is you now only have 2 columns, without donor restriction and with donor restriction. And in addition, if you look at the detail within the top table, you'll see 2 new line items representing the original gift amount and the accumulated investment gains amount. And this is part of the additional disclosure I just mentioned. If you have endowments that are underwater, you may choose to show a line item within this table, or maybe choose to disclose the amount in a narrative format. And you could either do that, maybe where you disclose your policy regarding spending, spending from underwater endowments, or maybe right after this table. But it needs to be disclosed regardless. Here's an important thing I want everybody to remember. When you are calculating the disclosure for underwater endowments, this is done at the fund or gift instrument level. You cannot net an underwater endowment against an endowment that is to the positive to get a net amount for disclosure. So what I mean by that is, let's say you have two very distinct types of endowments. You have one for scholarships and you have one for capital maintenance. If the scholarship endowment is underwater by $10,000 and your capital maintenance is good, by $25,000, you would still need to disclose that scholarship endowment is underwater by $10,000. Even though when you net them all together, it's positive, at that gift instrument level, or at that level for scholarships, since there are 2 different distinct types of endowments, you would need to disclose that. The second and last accounting change under the new standard relates to the expiration of capital restrictions. And again, this is within this section because these both impact the net asset classes. Currently, you have a choice, as a nonprofit, you have a choice. Release the restricted cash when the asset is placed in service, or release it over time. Under the new standard, only placed in service applies. unless the donor is explicit as to the length of time of the item's use. Absent specific donor stipulation as to how long that asset must be used, restrictions expire when the asset is placed in service. And with that, I will turn it over to David to discuss liquidity.
Okay, thanks, Alyssa. So this next topic we're going to cover are the new requirements around liquidity. Quantitative and qualitative information about liquidity will be required for the purpose of providing financial statement users with an understanding of an entity's exposure to risks, as well as how an entity manages its liquidity risk, and information about the availability of assets to meet cash needs for general expenditures within 1 year of the balance sheet date. Presenting a classified balance sheet may be an effective way for organizations to comply with many of the new disclosure requirements. However, many organizations already do use a classified balance sheet, so for them, it could potentially be a no-change item. The quantitative requirements include presentation of the total amount of financial assets, and then get down to an amount that can be used or is intended to be used in the next year to pay general expenditures. The qualitative information is disclosures on how the entity manages its liquidity, including uses of lines of credit and its policies for establishing reserves. There are clearly many ways an organization could satisfy these requirements, and while the FASB has given some examples, the expectation is there will be many different resulting disclosures. Now we're going to go through a couple of examples. So here's the first example for the quantitative portion of the disclosures. It's important to point out that if a classified balance sheet is used, meaning you show current assets and non-current assets, then this quantitative disclosure could potentially not be necessary. However, as seen in this example, there'd be a couple of items that would not necessarily be clear from clearly the classified balance sheet presentation. For example, potentially donor-imposed time or purpose restrictions on assets or board designations. So this example starts with financial assets at end of year, and as seen in the bottom of this example, there is a detailed breakout of how to arrive at financial assets, total assets less property and equipment, inventory, and prepaids. Then the disclosure goes through and backs out items that would limit the availability of financial assets for a variety of reasons, including limitations on availability due to time, purpose, or board descriptions, board designations. On our next example, so this is again the quantitative liquidity disclosure. This is actually a more direct approach. So here we would simply list items from the balance sheet and reduce them by any potential time, purpose, or other limitations that would make them unavailable in the next 12 months. So in theory, these items will not tie directly to the face of the balance sheet. So rather than starting with financial assets as listed on the statement of financial position and showing the deductions, this option would be to list each asset which has amounts available to meet general expenditures. Now to point out, when you look at operating investments on this example, there will be some judgment in some cases in what would qualify as an operating investment or an investment that meets the definition of a financial asset and could be converted to cash in the short term. In these situations, the intent of management and the use of funds is the important distinction. This intent would then be something that would be disclosed in the qualitative footnotes, which we're about to get to. Obviously, this would not typically be a consideration for endowment type funds. However, in relation to multi-year CDs or other long-term fixed income investments, there would be some judgment as to management's intent on length of time to hold those investments. So now we're going to show an example of the qualitative disclosure requirement. So this example begins with an explanation that the entity has a policy to have assets available for general obligations as they become due. The disclosure further explains how the board has created a fund to support any financial distress or immediate needs. Then this example finishes by explaining available line of credit dollars. I would like to point out that this example does not cover any of the investment judgments that I just mentioned on the previous slide. And should there be a need to explain intent on the use or definition of a financial asset, then that such intent should be explained here in this footnote. I just want to point out that any time the FASB requires qualitative type of information, there are debates on how much example or how much detail to provide. So they would not want to go and say, well, let's give too thorough of an example and then have the result be every entity uses their example, and that's where everyone ends up. But practitioners do always ask for detailed clarification on what does that mean and provide us an example. So while they have provided an example here, the expectation is that not every disclosure will closely align to this example here. It's really important to just truly go through the conceptual items that are required and tailor a disclosure that matches your entity. So the standard asks that the disclosure be made that is useful in assessing the entity's liquidity and communicates how a not-for-profit manages its liquid resources available to meet cash needs for general expenditure within 1 year of the balance sheet date. So this is the baseline that is required. The standard does list a couple of other items that in special circumstances, they should always be disclosed. And those examples are unusual circumstances, such as special borrowing arrangements that would require cash to be held in separate accounts. The fact that the nonprofit has not maintained appropriate amounts of cash to comply with donor restrictions, or information about significant limits resulting from contractual arrangements, such as agreements with suppliers, creditors, or loan covenants. So there will definitely be some challenges around these new liquidity requirements. The liquidity disclosures will be required of all not-for-profit entities and will be challenging for some. Ones that do not currently use a classified balance sheet, there'll be a little bit more change, but honestly, in my opinion, I don't see the classified balance sheet satisfying the requirements for most organizations due to the fact that in many cases there are purpose restrictions and board designations that will limit the actual available financial assets for the next 12 months. So we'll also potentially highlight difficult financial situations for some organizations. While financial difficulties would normally be evident from financial statements, this could further highlight the struggles for some. So now we're going to move on to our next polling question.
Great, thank you, David. We'll go ahead and launch this next polling question to get a feel for everyone's opinion on this one. The question is, how much do you perceive that the new standard will actually change your financial reports? A great deal, somewhat, or not much? So please take just a few seconds and go ahead and log your responses. We'll take a look at the results in just a second. As we give some consideration to these reporting changes, remember that this new standard is one of several that are actually taking effect soon. That's been one concern that I've had from clients is we have this standard, but we have some more as well. Remember that we have a leasing standard and a revenue recognition standard that are effective for most non-public entities ending in either 2019 or 20, and those can have a really major impact on our financial reporting. Just as a reminder, we've got lots of good information on our website at CRICPA.com about both those standards on leasing and revenue recognition. But we will be applying all these pretty much in rapid succession, one after the other. And so I know that we do have some that are looking at maybe early implementing this standard so that they can deal with the others when they come along. We'll go ahead and close the poll out now and take a look. And it looks like we have 13% say they will change their statements a great deal, 62% say somewhat, and 25% not much. And that's about what we kind of see, I think, with most of our clients as we talk with them about what they perceive the changes to be, and as we're looking at with them at the specific details of what's going to take place. So we'll go back to David for our next topic here.
Okay, thanks, Brian. This third topic was actually one where the ending standard had many changes from the original exposure draft that was put out by FASB. The original exposure draft of this standard had significant modifications proposed to the statement of activities. One of these options that they suggested in the exposure draft included breaking up the statement of activities into 4 sections, and those 4 sections potentially were going to be operating, non-operating, investment, and transfers. Other options included breaking up the statement of activities to more similarly mirror the cash flow statement. However, these changes were met with lots of concern from the profession, and these approaches have been postponed to phase 2, something that Brian had mentioned about earlier, about a phase 2 of this coming. So actually this new standard actually just reinforces current GAAP about transparency of using any operating measures. And so what an operating measure means is in a statement of activities, including a subtotal in the statement of activity, where before getting all the way to the bottom, we may list a change in net assets from operating activity. And then below that, we would have non-operating activity, then get to an ultimate change in net assets. So operating measures are currently allowed and will continue to be with the standard. However, the board is again stressing the transparency of what is included in operating activity. However, they haven't specifically defined what is an operating measure, thus what is a non-operating item. So the standard also discusses disaggregating internal transfers between net asset types. One of the example statement of activities included in the standards includes net assets released from restriction from investments under donor-imposed restrictions, and then just another item. So now let's get back to Alyssa to cover reporting of expenses and investment returns.
Okay, thanks, David. Under the new standard, all nonprofit organizations, you will be required to present expenses by both function and nature in one location. This may be done as a separate statement of functional expense, maybe in the notes to the financial statements, or on the face of the statement of activities. Best practice and what we see with most of the clients we work with will be presenting a statement of functional expense. But again, any of the methods are acceptable under the standard. You will also be required to provide a narrative on which costs are allocated and the basis of which those costs are allocated. And finally, really, while the standard did not change the definition of what are program and supporting activities, it does provide more robust information regarding allocation of expenses to management in general. So let's look at an example of what this will look like. All right, so this is an example of what will be required. You see you have both natural categories of expenses, such as your salaries, occupancy, travel, and that's done by the various functions of major programs. And in this example, there are 2 major programs, and also by supporting activities, which include your management in general and fundraising. The level of detail you present is up to you. It comes down to what provides, again, the most useful information to users of your financial statements. One thing to note, because salaries and benefits, this is such a significant component of most nonprofits, best practice will be that this should be presented as a separate line item. But the detail really of natural expenses from there, and even what is defined as a major program, these are going to be dependent on your organization and the users of your financial statements. You'll also be required to provide a narrative, as I mentioned, regarding the allocation of expenses among functions. Currently, your financial statements may have a very general disclosure regarding allocation of expenses, and this will likely need to be beefed up under this new standard. Fortunately for us, for you, for us, for all of us, the FASB decided using percentages and other quantitative measures would be too much, so really just the qualitative matters need to be included. So as an example, the expenses that are allocated include depreciation, interest, office and occupancy, which are allocated on a square footage basis, as well as salaries and benefits, which are allocated on a basis of estimates of time and effort. So again, a little bit more robust than what you may have right now, but you're not having to say, well, 22% of salaries went to management and general because of X. We don't have to get that detailed. So switching gears just slightly to investment returns, this slide, I'm going to tell you, has something completely different than you've seen on any other slide. This slide is actually just letting you know of something you no longer have to disclose. Investment income now will be presented net of expenses, and expenses can include both internal and external fees. And you also are no longer required to disclose the components of investment income. So your unrealized gains and losses, interest, dividends, etc. And this was done because it was determined that the information really being presented was not accurate in all cases. Again, that inconsistency that we talked about in the very beginning. So it's been eliminated. You can absolutely continue to disclose it if it's meaningful to use as your financial statements, but again, you're not required. So that basically wraps up changes related to expenses, and I'll let David wrap up with the cash flow section.
Okay, thanks, Alyssa. Again, this is one of the areas when the exposure draft of the standard was came out. The board wanted something else. They actually wanted to require the use of the direct method of cash flows. However, this requirement has likely been postponed to phase 2. What was left is that the direct or indirect method could be used, same as today. However, typically anytime the direct method has been used in any set of financial statements, a reconciliation is required at the bottom that presents the indirect method of operating activities. So you ended up, if you showed direct, you really showed both. Therefore, people just presented the indirect method to not double up on information or effort. However, now if you present the direct method, the indirect reconciliation is no longer a requirement. Actually, in researching this issue, the FASB polled not-for-profit board members who are not CPAs. They were given both methods of a cash flow statement and asked which one is more clear, and 95% of those board members said the direct method. So, and also the FASB has long themselves considered the direct method better information, as the indirect method is not any new information. This change is really encouraging not-for-profit entities to present the direct method of operating cash flows. So we'll move on to an example. Again, this is not new. The direct method of operating cash flows has been around for a long time. However, historically, it's not really been overly common. The name direct method is actually an accurate description, as this method shows direct cash flows of funds. So where operating cash flows are coming from and where operating cash flows are going. What you'll see, what's not included here is the change in balance sheet items and their impact on operating cash flows, which is the indirect method. So this method is deemed to be clearer and better information for users of financial statements. And then just as a refresher, this last example is our continued indirect method. This reconciliation is no longer a requirement with the new standard when presenting the direct method of cash flow. The thought is that removing the reconciliation requirement, more entities will present the direct method. Now, before we get on to our last polling question, we wanted to point out a couple of items. Early adoption of this new standard is permitted, and actually many of the changes can be implemented now without implementing the entire standard. For example, the liquidity information. However, there are specifically 4 items that cannot be piecemeal implemented, and those are changes around presenting one class of restricted net assets, underwater endowment accounting, eliminating disclosures of investment return components and netted expenses, and the cash flow statement changes that we just discussed. So now we'll do our last polling question.
All right, thank you, David. The last polling question that we have for you, what component of the new standard gives you the most concern as you consider implementation? Is it the net asset classification, the liquidity information, operating measures, expenses and investment returns, or maybe the cash flow statement? If you'll take just a few seconds and go ahead and respond to that poll, we'll take a look at what our group thinks about this one. As we're doing that, I just mentioned, I said earlier that there's still changes that we expect in the future as the FASB continues to study nonprofit reporting issues. As we said, they're not finished yet. We do believe that one of the things that will be addressed along the way is going to be some specific guidance for various types of entities. Specifically, I think the higher education, those of you in higher ed, and healthcare entities. I believe those will be ones that they will definitely want to address some specific issues that maybe don't relate to the rest of the nonprofit population. So we'll go ahead and close that poll out and take a look at our responses here. We had the significant majority said the liquidity information, which I will tell you is pretty much what I have seen from my clients. That's the one that everybody brings up and says they're kind of concerned about coming up with that information and presenting it in the proper form and so forth. I know that that's an important measure that that donors and lenders and so forth will be looking at. So that's the most, 42%, 19% for operating measures, 16% for net asset classification, 11 and 12% respectively for both the expenses and then the cash flow statement. So that pretty well lines up with what I've been hearing from my clients most recently. So we'll go back to David for take a look at the last few things here.
Okay, so we have just 3 last things that we want to communicate that we have mentioned this phase 2. So one of those areas is this use of an operating measure in the statement of activities, which again is an interim net change in assets, and whether the statement should be required to be broken up in sections or more clearly defined what is operating and non-operating. For example, in the option that I mentioned earlier about breaking down the statement of activities into 4 sections, there would be one section for investing, which would include all investment activity. So therefore, for organizations such as foundations or other ones with significant funding through investments or endowments, those organizations would show minimal income in their operating section and overall operating change in net assets. So this was met with heavy resistance, and one of the reasons why this item was postponed. The next item will be some changes to the cash flow statement, and really where certain items show up in the 3 categories on our cash flow statement between operating, investing, and financing. The idea is to more mirror changes in operating net assets on the statement of activities with the cash flow statement. So some items that have been previously included in investing or financing would now be reported as operating, or items that have been included in operating would be moved out. Until a clear definition of operating income and that operating measure is provided, it's not totally clear yet what these changes will likely be. And the last item for consideration relates to healthcare entities, something Brian just mentioned. The natural and functional expense classification causes some issues for healthcare type entities. So an alternative that's being discussed is segment reporting that they would have in lieu of the requirement to provide an analysis of expenses by both natural and functional classification. Now let me turn it back over to Brian to wrap up our session today. Thank you.
All right, thank you, David and Alyssa both. Just wanted to make a few final comments here. As this new standard is being implemented, we know that there are a lot of people who will have some questions about it, some issues for their specific organization. We do offer from our firm a free 30-minute consultation with us about maybe whatever questions or issues or challenges that you see. You can see that there is a place there noted on the slide at the NFP reporting consultations where you can register there for a free consultation to get us to help you look at your steps that are specific to your implementation of the standard. You may also find more information on adopting that new standard, which I think can really be a breeze if your nonprofit will tap into our expertise. So as Dr. Seuss says, will you succeed? Yes, you will indeed. 98.75% guaranteed. Always love some wisdom from Dr. Seuss. With that, we know that each of you participating will be successful in implementing the new standard. Want you to be aware that we are available to assist you in any way that we can. If you have any specific questions, be glad to entertain those with the time that we have remaining. I do have a couple of questions that we've gotten so far. One question is, does the new standard include any exceptions for smaller nonprofits? David or Alyssa, you want to respond to that?
Sure. And the answer is no. I mean, the FASB considered whether there should be any exceptions, but as is often the case, they don't like setting different standards for different organizations. So, you know, right now, it applies to everybody, no matter what the size. They will often extend the implementation timeframe for the standards so that everybody has an opportunity, you know, to make any necessary changes. But right now, it covers everybody.
We're all in it. That's right. Another question relates to the possibility of including some management discussion or explanations in order to supplement these requirements of generally accepted accounting principles. The answer to that is yes. Most of the financial statement users do understand that financial statements kind of have their limitations. And so, you know, they realize that, you know, not everything can be measured by one single metric. The FASB didn't really address, I guess, specific commentary that management could use in the new standard, but certainly many of that FASB committee do strongly, I would say, encourage the use of management commentary to help explain, you know, your financial story. So I know at CRI, one of the things that we've routinely encouraged even our smaller nonprofits to do is to each year to prepare a relatively simple annual report. Doesn't have to be extensive, but I think to have an annual report that gives some plain English, something that's understandable, not necessarily all the accounting jargon that goes in a financial statement, but some descriptions of what your entity has accomplished during the year, what your activities are, and that sort of thing. And I do think that's a significant thing. So I would recommend that for sure. There is another, we have a question about will your website have more detail on operating measures sources as they develop? And the answer to that is yes. We do try to keep a lot of things in our website as we you know, move ahead, and we'll be adding some things. We've got some new articles that are actually in process right now. They'll be coming out about the new standard. But if you go to our website at cricpa.com, you will find several things that I think would be helpful for you. Question regarding the organization's budget. Does that determine if you need a financial statement, I guess a non-audited statement versus an audit? Really, we could, I think we've got some information on our website about that as well, the different levels of service that a CPA firm can offer, compilations, reviews, audits, that sort of thing. Audit is the highest level of assurance that a CPA can offer on a financial statement. Typically, that's decided by the organization itself as to whether they feel the need to have an audit. The audit does give more assurance to the public that's out there. So donors a lot of the time do like seeing audits as opposed to a non-audited financial statement. And sometimes you can have, depending on your state location, you can have state law that controls that and will actually require you to present an audit as opposed to a review or a compilation.
Yeah, and one thing to add to what Ron. Oh, sorry, David. Go ahead.
I was just going to say, Alyssa, that you know, that question, the way I kind of thought about it is, you know, we do have rules based on the size of the organization in relation to the type of tax return that's required. So whether you do a regular 990 or not, but that doesn't drive the need for an audit.
Yep. Yeah, because I mean, this standard applies. That's absolutely correct. But this standard applies to if you are presenting financial statements in accordance with generally accepted accounting principles. If you are presenting GAAP financial statements, whether it's an audit or a review, you know, that the level of service, you know, the level of audit service isn't driving that. It's GAAP. If you're presenting GAAP financial statements, these rules are going to apply.
We do have one additional question here. You know, if management reports that are prepared by the organization indicate detail and notes, a lot of information in there, is it appropriate to be more simple with financial reports? And I think the answer to that is, you know, the financial reports that, and what we're talking about with the new standard is that is controlled by the Financial Accounting Standards Board. So if you're presenting a formal financial statement that is prepared by or either certified as an audit by the CPA or whatever other form of financial statement, you will have to comply with the standard. So you have to meet the minimum. Now, it may mean that you've got some additional information outside of that. So you could be with your reports, your external financial statements, be fully compliant with the standard, but you don't necessarily have to go overboard and could keep them as simple as possible while still complying. And then from there, make whatever additional management reports you'd like to make. That's pretty typical too. Only other question I had so far is, and then we'll close out here, the question about are all nonprofit organizations affected, and if not, what types are outside the scope of the new standard? The answer to that is really basically every nonprofit as defined by the FASB accounting standard codification is affected by it and needs to comply with it. So that's going to include a lot of you here on this call, things such as charities, foundations, private colleges, healthcare providers, that sort of thing, religious organizations, trade organizations. So it would not include things like investor-owned entities or those that provide dividends or that sort of thing proportionally to their owners or participants, which might include things like cooperatives or maybe some mutual insurance entities or credit unions. So it does not apply to those, but it applies to every other nonprofit. So we'll just kind of leave it at that. All right. We'd like to thank you very much for your participation today. As I mentioned earlier, we will be providing a link to the recording a little bit later on today or in the morning, the next 24 hours or so. We do appreciate you being with us. Certainly go to our website, go to the link that you see for consultation. We'd be glad to come and visit with you or conference calls or whatever might work. But thank you for your participation and hope to be able to talk to you soon. Thank you very much, everyone.